Hello everyone, my name is David Presson and I'm the Director of Investments for First Bank Wealth Management. Today I'm going to talk about that hectic time of the year between Thanksgiving and the end of the year. No, I'm not talking about the holidays, but I'm talking about year-end tax planning with your investments. As you look at your portfolio, there's 4 factors to consider: delayed buying, delayed selling, capital gains distributions, and tax loss harvesting. First, let's talk about tax loss harvesting. This is a process at the end of the year. You can sell any investments at a loss to offset gains you've taken earlier. You can net any short-term gains versus short-term losses, and the same with long-term gains versus long-term losses. Any investment you've held more than 12 months is considered long-term. Anything less than that is short-term. So if you've taken any gains this year, look for any investments where you have a loss to help offset that gain and reduce your tax burden. Now, in this market with virtually everything up, it may be hard to find those types of losses, but search your portfolio just in case. After selling the investment, you can buy it back later, but you have to wait at least 31 days or the IRS will disallow the tax loss. But when you sell something, you don't want to lose your market position, so you can replace it with something similar. For example, you could sell a growth stock fund and replace it with another growth stock fund. Or you could sell a stock like Exxon and replace it with Chevron. As long as you're not replacing it with a similar type security, for instance, a Vanguard S&P 500 index fund that you replace with another index fund from another provider, as long as you're not doing that, you're fine. So it's also important to know that long-term gains are taxed at lower rates than short-term gains. So if you have anything you're thinking about selling, try to wait at least 12 months until it becomes long-term, or even better, wait until January to defer those taxes for at least another year. Now let's talk about capital gains distributions, a dirty little secret of the mutual fund industry. Mutual funds throughout the year buy and sell a number of securities. By law, they have to pass along all those gains to their shareholders by the end of the year, and most of them do it in December. Some mutual funds tend to be more tax efficient than others. For instance, most index funds don't do as much trading, so they tend to be more tax efficient than most actively managed funds, which do a lot of transactions. So most of these funds are paying out these distributions in December. So even though you don't sell these funds, you still hold them, you're still liable for that capital gains distribution. So it's important to know the timing of these distributions to make sure you don't buy into these mutual funds right before the distributions. For example, you could buy in one day and the next day they make a distribution. You're liable for those taxable distributions for the full year with no added value. So within wealth management, we track all mutual funds and when they're paying out those distributions to avoid buying them in advance, as well as taking losses where necessary. So if you stay on top of all these issues, your portfolio will do a lot better after taxes, and you're going to have more money to spend each holiday season. So thanks for your time today, and if you have any questions or feedback, please send me an email.